Nigerian equities market year-to-date performance is hovering at 12% on the back of sustained interest by consumer goods index, while the banking index is witnessing a hit following the directive by the Central Bank of Nigeria to suspend dividend payments and bonuses over unresolved regulatory forbearance exposures. Haruna Jalo-Waziri, the CEO of the Central Securities Clearing System, joins me now for an outlook on the market here in Nigeria. Thank you so much for your time today, sir. And let's start with the snapshot we've seen so far in the first half, and what's the expectation for the second half of the year?
So, thank you, Ken. What we're seeing is a sustainable, growth in terms of volume and value being traded in the market, and we've seen it grow. If you compare, like with half year of last year and almost half year of this year, you're seeing 2.5 times in terms of value being traded. You're seeing about 2 times what was traded last year compared to this year, and that kind of gives us confidence that the fact that the market has grown significantly just from 1 year, and is primarily what we see driven by our own domestic investors, which is really reassuring because it tells us that the bunch of savings that are being accumulated in Nigeria is actually being plowed back into the market.
Yeah, quite a lot playing out there, and I'd like to get to a story that is a bit more recent, talking about those unresolved regulatory forbearance exposures for the banks, and we've seen that wipe out some value from the banks today. Let me get your take on those sort of regulations and how that also affects sentiment in the market.
So, whatever regulators do typically affects, markets generally, and the central bank had issued this circular indicating that because of the certain forbearances given to some banks, they can't do certain things, including pay dividends, make investments outside. Rightly in some form or shape, because they're trying to protect, if you like, the integrity of those banks from a balance sheet perspective and ability to be, continually be able to perform their duties as banks. But the other impact that you'd see, like we're seeing in the stock market, is a bit of a drop in those banks that are involved. I think primarily, I just was reading one report earlier this morning about the level of forbearances given by those banks and where they would be. But there's some confidence being said that some of them will actually start paying dividend from as early as 2026. Some might take to 2027, 2028. But the stock market is always a long-term perspective that you should look at. I think those banks still have strong earnings, and I think they'll bounce back very quickly.
Let's look at the dynamics at play in terms of investment flows for the local and foreign investors and what we can expect down the line.
So we're seeing more local investors participate because if you compare last year's data and this year's data, about 36.7% or thereabout, or 37% of what was being traded daily in the market was actually foreign investors. The reverse has happened. We're seeing about 78, 79% of what is being traded, or even more, now is by local investors. And we need our markets to be domestically focused, because any color that happens within the industry, within the economy, the foreign investors always pull out, and you tend to see a run. But once you have domestic investors who understand the economy, who are here and can interpret what's happening in real time, I'll actually make the stock market more stable.
Yeah, because we're doing in a year where we've seen quite a lot play out. The first half of the year, when you look at some of the things that shape the markets globally, geopolitics, tariffs, uncertainty, quite a lot played out this year. Looking into the second half of the year, and for you, what do you think will drive sentiment or hold back sentiment down the line?
So you just mentioned in your news report about where the Brent price is. That is a huge impact in terms of how our economy behaves. And once you see oil prices go up, we have hopefully steady our production or increase it. What it means is that we're earning more, and when you earn more, the government has more disposable income to spend. And by extension, it expands the economy. And by extension, the economies also prosper. So for us, good and bad, oil prices always help in terms of growth of our economy, because we are really dependent on most of that. But more importantly is that, again, if I refer back to the data earlier given, we're seeing more and more domestic money actually going into our market, which for me, it's a very, very good thing. Pension funds are very active. Fund managers are there. And we're seeing high net worth individuals coming to the market. It all sounds very good for the second half of this year, in my mind.
So now let's look at the internal infrastructure within the exchange here and talk about that transition that's playing out there, especially with accelerated payments, the transition from T+3 to 3+2, and what that will mean in terms of for the markets here in Nigeria.
So I always tell the story. Ken, you and I think at some interview back in there, I told you about how my 23-year-old son, 24-year-old son, who told me, Dad, I asked him, I said, why are you not playing our market? He said, well, if I buy goods or service, some goods, for example, at Amazon in the morning, I get it delivered in the afternoon. If I don't like it, I return it, my money is back within a couple of, or replace the product. He says, in our market, it takes me 3 days to get my asset if I buy. And if I sell, it takes me 3 days to get it back. So that's why I'm not participating. When you bring it closer to T+0, T+1, you're likely to see young people participate. Where an economy of very young retail investors that are out there that like to participate. But more importantly is that other markets have moved to T+1. The US has done that, a few countries, India and I think some Asian countries as well as Europe is likely to also go to T+1, I think, by end of next year. The point I'm trying to make is that we also need to move across to that extent. T+3 is still a cake. It takes too much time to... What it also does is that it gives us more liquidity within the context of our market because there is a higher turnover volume that's going to happen. And I think because we're also a no-fails market and we pre-fund, the issues that other markets have in terms of transiting from T+3, T+1, we don't have. However, the SEC has released guidelines as to how this will be done, talking to all of the, if you like, participants in the market. And so we're going to T+2 first, and then move to T+1 subsequently. I'm excited about it.
Definitely quite a lot to look forward to, but thank you so much for your time on the show today. We'll definitely be keeping an eye to see how the developments play out. But thank you so much, Haruna Jalo-Waziri there, the CEO of the Central Securities Clearance System here in Nigeria.